All right, thank you everybody for joining us for this fireside to end the day. Catherine, can you just give a quick background on you and TechEquity?
Yeah, so TechEquity is an advocacy organization. We're based in the Bay Area. We work on issues at the intersection of tech and economic equity, trying to make sure that as the tech economy grows, that more people are benefiting from that growth, and that the sort of rise of AI is supporting human flourishing instead of extracting and exploiting.
Okay, and Worldeaters is a provocative title. And so what is the backstory behind this book? And can you give us a little bit of a story of how you got to covering what you covered, the ground that you covered with that book?
Yeah, so as I said, I'm an advocate. I'm not a venture capitalist. I didn't start out knowing that much about VC or finance, but doing a lot of work around 2018 on workers in the gig economy and thinking through how we could create structures that would create better job quality for gig workers. I was at a meeting with some labor advocates and folks in tech and academics, and we were thinking about like, how would these structures look? How would we get companies, gig economy companies, to like buy into some of these structures? And they were all sort of like good ideas that weren't, anti the business, like could have been incorporated into the business. And at some point in the conversation, I was thinking like, when in the life cycle of these companies could they actually step back and think about these questions? And it feels like in startup land on a Tuesday, it's a 10-person company with, runway for who knows how long, and you don't know whether you're going to exist in a few months. And then by Friday, you're at Davos and, this like multinational, too big to fail company. And the speed and scale that tech companies worked on felt different to me. And it started me asking a lot of questions about whether this was actually different from other industries, if so, how, and what did that mean for the issues that we were working on. And once I had that seed planted, I kind of saw everything through that lens, and finally came to the conclusion that a lot of the challenges we were working on in labor and the economy were actually driven by the venture incentives around the technology and not the technology itself. And most of the people who I was working with on tech policy issues didn't really understand the role that those business incentives were playing. And I thought it was really important to make that clear.
So it sounds like you dug into that specifically, and that's kind of how you came about with the book and everything that you kind of landed on, the sort of the thesis behind what your thinking is. So if you were to kind of sum up that thesis right now, well, maybe we can go with the one statistic that, because I'm obviously a data-focused person here. So what is the one statistic that helps showcase what your thought process is in here in writing Worldeaters?
Yeah, well, before I get to that, I think a little bit of setup is that when I started writing the book, the idea was, and the way I pitched it to my publisher was, we've got all these books about companies that, were these spectacular failures or, scandals or whatever. We've got Theranos and WeWork and FTX, and, there's a book on each of them. Some of them have TV shows, but they have a common thread, and that common thread is the capital that kind of, I argue, forced them to operate in a certain way, or that they took advantage of, or, that was attractive to grifters. And I thought the book would be about that. And as I talked to more entrepreneurs, many of whom, are similar to the folks in the room, it turned out that the more interesting story to me was actually the companies that weren't getting funded, or that didn't have the natural potential to be venture scale companies, but that were solving a real problem, or, had a real market to address. And they either couldn't find funding, or were being forced by venture capitalists to sort of shapeshift into a model that could look like a venture scale company. And that game about selling and storytelling and all of that was just really interesting to me. And so ultimately the book became about the mismatch of capital in the entrepreneurial ecosystem, where most companies, the vast majority of companies, are not going to be, Stripe or, OpenAI. but they're good businesses. And why haven't we been able to find a capital model that takes advantage of their natural opportunity? And for me, I work in, one of the chapters is about housing. There are areas of the economy where we desperately need innovation, but where venture capital is really the wrong model for the market opportunity available. And if we aren't figuring out how to structure funds in a different way that meets that need, we're first of all, not going to solve those problems, but we're also missing a lot of richness in the economy that could do a lot of good. So the stat, I guess, I think, I don't know how many companies a year are actually end up becoming unicorns that are founded, but Andreessen Horowitz bets that it's about 15. So if you think about it, I mean, how many companies are represented even just at this conference, right? A lot more than 15. And maybe this is just US-based companies that they're talking about. But there are thousands of companies that get started every year. There are thousands of funds and fund managers who are chasing those 15 potential unicorns. And that to me says that, like, why hasn't anybody figured out how to craft a capital structure that works for the other 99% of those companies? And I know there are a lot of people doing that, and I talked to some of them for the book, but it feels like it isn't sort of in the zeitgeist that that's a way to approach investing that could really work.
Right. The headline stealers are always someone raised this inordinate amount of money, or whatever, anyone who's on the path to that hyper-scaling, anyone that's who gets celebrated, basically, right?
Right.
And the people that you're talking about that are making innovations in this ecosystem, that are finding ways that good companies continue to scale and grow, are not necessarily being covered as much. So I'm interested in, like, the incentive behind that. Like, why is the current zeitgeist set up this way, and how did it get to this point? Like, what were the changes that happened that led to this?
Yeah. I mean, it's a multifaceted question, and I don't know that I have a satisfactory answer. It's a lot of different things. I mean, I think we were in an environment where interest rates were so low for so long. It was kind of unprecedented, and I think that embedded a lot of bad habits in VC and in entrepreneurship. I think people took a lot for granted that money would always be around. And I think it became something like dogma that, just pumping money into money-losing businesses over a long period of time and just hoping they get to scale would work enough times that, like, the business model for a VC fund would work. Kind of because it was the truth for so long. It's like a whole generation of venture capitalists and founders, really, who came to believe that this was always going to be the case, and it's how they learned how to practice, right? It's not true anymore. I'm not sure how long it will not be true for. We may have interest rates at zero again soon. Who knows? But I think now, and this is an interesting time to be having this conversation, I think people are willing to re-examine those assumptions that have just kind of been taken as ground truth for the last 15 years or so. And I think that, like, we can maybe start having a conversation about, like, okay, so if money isn't free and you really do need to have a sustainable business at some point, or as we were just talking about backstage, like, if AI-driven companies just don't need that much money to scale anymore, like, what does venture capital do? How do you structure a fund that can actually return to somebody given those truisms now? And I think that's I'm not a VC, but I think that's a really interesting question for folks to be answering. I do think limited partners have a huge role to play, and I am very clear that they're really driving the incentives here, and their behavior is making it really hard for GPs to think about doing something differently, because it's really hard for them to walk into a meeting with an LP and say, hey, I want to go outside the box and, like, not do the power law thing.
Not do the power law thing.
Yeah, and get them to invest in their funds. So I do have sympathy for that, but I think it's long past time for a revisitation of a lot of the assumptions that people have held to be really true in VC, and just are not serving VC, definitely not serving most founders, and certainly are not serving society.
I've also talked to some, this is kind of just a side point, but I've talked to some GPs who have basically told me that regardless of the company that they're investing in, they have to spin it a certain way to sound like an AI company right now, or something like that, so that the LPs will be like, yeah, this is exactly what you want, where we want you to put this money.
Yeah. And 10 years ago, it was everything had to be a marketplace, right? Uber or whatever, right? Yeah, I had one founder tell me, her quote was, VCs ask us to lie to them in very specific ways. And that feels like, all the conversations I had about the subtle way in which the interaction with VCs shaped how founders thought about the value of their business. Every meeting getting, implicit or explicit feedback about whether this was going to work. Hearing from founders who were like, I was building a listing service, I couldn't raise any money, but then I went in and called it a marketplace, and all of a sudden I had millions of dollars overnight. It wasn't a marketplace, and that business failed, and it should have just been a listing service, and that would have been a really successful business. But I couldn't raise money if I was calling it a listing service. So, I think there are some parts of it that are just sort of intrinsic to investing in startups. You just don't know which companies are going to be the 15. And so it does lend itself to storytelling and fake it till you make it. And some of that is good, and it's good to be sort of hopeful. And
as an entrepreneur, you have to be hopeful. You have to be optimistic.
And I'm a founder too, not of a for-profit company, but I know how that is to try to sell somebody on a vision when you have nothing to show for it yet, and just hear no 1,000 times, and still have to keep going with that sort of delusional hope that someone is going to finally see what I see in this. So yeah, it's tough, but I think it's really important if there's one thing I hope this book does, I hope that founders get the message that the company they are building, they should stay true to that and really find an anchor. And that hopefully the funding environment is changing enough that investors will start to see the value in what they're building as well. I have a lot of stories in the book about founders who did hold on to that, and it felt hard in the moment, but it turned out to be the best thing for the business in the long run.
So I want to go over some of the current trends in the tech landscape right now. We've already kind of touched on some of them, things like AI and how the venture capital business is just changing as a whole. And so I'm just interested in how all of these different current trends factor into what you talk about in the book, because it's kind of like taking everything from the book and from your thought process and thesis and applying it to what a lot of people are asking questions about today. And then after that, I want to talk about some of the protagonists in this story that are helping change the model. So let's firstly go to some future-looking stuff. So I don't know if you've heard of this AI thing, but apparently it's going to be pretty big.
What is that?
I don't know. I don't know if anyone else is talking about it at the conference. But so from a founder perspective, I've been watching it, and obviously we're trying to harness it as well. But it's really interesting when you're looking at the interplay between startups and venture capital. Obviously, startups can build prototypes much faster. They can go and try and find market fit much faster by automating some of these processes. At the same time, when you look at it from the other side, you have someone that can go and build a new company pretty much overnight, which can replace like a B2B SaaS company or something like that, the exact same software. Or a large enterprise company can go and build their own software that does the same thing that this hyper-growth startup is doing, and they can go and rebuild that very quickly. So with all of that considered, how does this factor into the story of the book? How does this affect founders and the venture ecosystem?
Yeah, I don't know that I have a very clear picture. First of all, anybody who tells you they know where AI is going
for sure.
is lying. But I think I could see this playing out in a variety of ways. One, yes, you're right, that founders could have a lot more agency, and it could solve that problem. My day job work at TechEquity, with that hat on, I feel very nervous about a future where companies don't have any employees. That feels hard to stomach, at least in the short term. I think that would cause a lot of economic turmoil. On another higher level, I did interview Sam Altman for the book before he got fired. And the section of the book is about governance models, and it was really supposed to be an example of how OpenAI's governance model was meant to protect the technology from the imperatives of investors. There were some furious edits I had to make to that section of the book over the course of the,
well, that was a whole saga.
18 months, exactly, yeah. But when I talked to him at the time, his point of view was this technology is too dangerous for investors to have that much control over it. That now is a very concerning thing to him have told me.
A little bit of a 360 on that.
Yes. So,
or 180.
And I think he's right. And, one of and it's not just because of the sort of doom or whatever X-risk stuff. It's because, investors are going to force OpenAI to become a monopoly. Investors will force Anthropic to become a monopoly. Anthropic also has a weird governance structure that maybe could prevent against that, but watch this space. I don't know that it's good for entrepreneurs who are building on OpenAI's platforms for OpenAI to have that much power. So in that sense, the investor imperatives that are maybe giving entrepreneurs more freedom to start their own companies are also empowering these, if we think, Meta and Alphabet and Amazon are, crazy monopolies like OpenAI, powered by AI, OpenAI is going to be much more powerful. And I don't think that's great for innovation or competition. So, we'll see how it plays out. I hope to have something to say about it. We're working on some policy solutions that maybe can check the power of the bigger actors. But I don't know that I would look at that development and say it's an unmitigated good for entrepreneurs.
Okay. We have about a couple minutes left here. Who are the protagonists in this story? Who do you cover in the book that is making a difference and helping startups being able to access funding that is a better fit for what they're trying to do?
Yeah, well, there's a lot of founders in the book who I would call protagonists, but one investor that I profiled is named Bryce Roberts. He runs a fund called Indie VC, and he really identified this math problem that I told you about earlier. And his thesis is there's as much money to be made designing a fund thesis around those sort of missing middle companies as there is to be chasing all the companies that Andreessen Horowitz and Sequoia are actually going to get. So why would I play that game when nobody's over here taking advantage of this set of companies? And so he's got some really cool tools and is doing very well. And I think the way he talks about the investment thesis is not charity, it's not social impact investing, it is capitalist. And that's what I think is really important to say is I'm not asking entrepreneurs to do something for the good of society. I'm not even asking investors to do that. I'm asking them to understand that when capital is misaligned with the business opportunities, you will have fallout to society that doesn't need to happen. And also, the economy is not as vibrant because all of these startups that could be doing really cool things are not able to find the funding that allows them to pursue those markets. So I would really encourage, I'm glad that Bryce is, showing the courage that he is showing. He's lost a lot of LPs because of it. But I hope that he is an inspiration to other investors as well. And I hope if you're looking for money, you check him out, Indie VC.
Awesome. Well, that was pretty much a mic drop answer at the end here. So I'm not going to add anything to that. We're out of time, and I think that was perfect. Thank you so much, and really enjoyed this conversation.
Yeah. You go off this way.